Hello from the Dukascopy TV studio in Geneva. We are back with a technical analysis with Jean-Francois Owczarczak from the Management Joint Trust here in Geneva. Jean-Francois, welcome to the studio.
Hi, Daniel.
So, we are at the beginning of June now. This is a decisive week. We are ahead of the non-farm payrolls. We also have press conferences from the ECB and the Bank of England coming up. And supposedly another new climax in the Brexit story. And again, the dollar increases in value versus the euro. Is this development going to continue?
Yeah, we also have OPEC on Friday, so another important event. Yes, well, we're back on our fin graphs mosaic. These are daily mosaics, so they give a perspective over the next few months. And we can see that here we have a euro-dollar, cable, euro-Swiss, gold, dollar-Swiss, dollar-yen, Brent, and the S&P futures. And as you see here, you have both euro-dollar and cable, which are still heading up in gray, but seem to have finished their correction up and could be slowly resuming the downtrend. We'll first focus on euro-dollar. Last time we spoke 2 weeks ago, we were still in our focus, so here we are on investor's view, so a combination of a weekly, daily and hourly chart for a perspective over the next few quarters, months and weeks. We'll start with the daily, so the perspective over the next few months. And last time we spoke, we're pretty much entering this corrective target zone. We didn't have any proof that it could actually reverse from there, but we had basically reached the objectives. And a few days later, the ECB came out and said that it would accelerate its bond buying program before summer illiquidity, and we've seen the result over the last few weeks. Now, for the time being, we're still in a slight bull. It seems like the correction targets have been met. And in light of the longer weekly trend, we believe that the trend is still down. Hence, given this bearish signal here, targets which are not yet fulfilled, which could bring us down to parity over the next few quarters, and given that the reaction up did create quite a nice intermediate bottom, but wasn't able to turn our envelopes, which are still heading down, we believe this was probably an intermediate reaction. Now, this intermediate reaction, as we just said, did reach its targets and could be in the process of rolling over again. It seems like this is already a fact on the hourly, so the perspective over the next few weeks. These have made it beyond corrective targets down and are now showing impulsive targets over the next few weeks, which could reach into 107 to 105. We are in a slight correction up at the moment. We can see the risk index is quite low, so giving some support here. And hence, we'll look at the shorter term view to have a perspective over the next few days. So here we are on the trader's view, so the perspective over the next week or so with a 60-minute chart, over the next day or so with a 15-minute chart, and over the next hours with a 4-minute chart. And so at the moment we're in a reaction up, short-term, intraday, but the 60 minutes and the 50 minutes are still heading down for now. We just want to look at the 60 minutes in more detail. It is in a bad trend again, but we'll go back maybe a few points because it did show some important levels here. So in this correction up, it remained a correction up as long as it didn't make it above 110.60. And so basically the 110.60 here we want to use as our warning signal. So as long as we're still heading down and don't make it above 110.60, we'd still be in a downtrend here. As this downtrend would confirm the hourly downtrend that we see here over the next few weeks, and be a confirmation that the correction up is possibly over and that we may be resuming in the downtrend in coordination with what we see here on the weekly.
Mm-hmm. So if we look to the gold, so the gold hasn't really gone over the mark of 1,225. What does this mean now? Okay, well, this is also an investor's view. So the perspective over the next few quarters with a weekly, the next few months with a daily, over the next few weeks with an hourly. We'll first look at the weekly. The weekly is still heading down and has been doing so for about 2 years. We still think there's some potential down, possibly to the lower 1,000 levels. There's probably a few more quarters to go, and our risk index is not yet an exaggeration. The daily is neutral. You mean you have a bullish trend indication, but you have no targets, which means the targets are heading down. And so we call this a neutral situation. Last time we were here, we were just when we made it above 1,225, which was an important resistance level. It was actually half the distance or the 50% retracement from the move down that we saw between January and March. It did also show a resistance here during the month of April. Now, what we said last time is that there were possibly more levels that really needed to be taken out before we could consider any reversal on gold. And we believe that the 1250 that already acted here as a resistance was an important level, and actually the 1300, which actually stopped the January rally. And so it basically did happen. We're moving back down again. We're neutral in a long-term negative downtrend. So at the moment, gold is still under pressure, and you can see this on the hourly, which actually made it below its corrective targets, and now similarly to what we see on the euro is heading down, and we can consider impulsive targets between 1166 and 1146. So following this correction up, it seems like gold is back into its longer-term downtrend, which seems to be confirmed by our hourly short-term.
Let's just also highlight another commodity, oil, crude oil. So you have mentioned the meeting of OPEC at the end of this week. There has been a correction since the beginning of the year. So can you walk us through what happens right now?
Okay, well, let's have a look at the daily chart, so the perspective over the next few months. It's interesting to note that this correction made it up to our corrective targets. We will continue to consider it as a correction as long as it doesn't turn impulsive. To turn impulsive, it would need to make it above 73.30 something. We're still some ways away. So at the moment, this move for us is only a correction. And in light of the longer term downtrend following the huge sell-off that we saw in the second half last year, we consider the reaction up to be an intermediate bottom at the moment. The trend is still heading lower with the envelopes heading down, and there's still some potential to make it down to 40 over the next few quarters. So in this respect, long-term downtrend, correction up, targets have been met, hasn't proven that it could move impulsive yet, and the short-term has made it back in impulsive targets down. Quite a sharp reaction at the end of last week with some exaggeration here. But if we consider the chart here at the moment, it favors a continuation of a downtrend. And talking about the OPEC meeting, well, it seems that we cannot expect any production cuts, and so that could put further pressure on the price of oil.
Mm-hmm. So let's look at the equities. So there has been a correction of the US equities last week. So what is going on and what is the outlook?
Well, as we've been saying since 2 years, we think we're still in an uptrend. Our weekly charts here is considering impulsive 2 targets, which are quite extended, but we would still have the potential to move up above 2200, possibly up to 2400 over the next few quarters. It is getting a bit expensive. You can see that the 2 envelopes are touching each other. You can see that our risk index is back in the red, but at the moment the trend is your friend and it's still heading up. On a daily basis, since December, basically, it has really tried to climb a wall of worry. It has made gradual new tops, meaning end of December, in the month of February, and just now in May. It is still an uptrend. There's still some potential. It could still move up to 21.63 over the next few months. We believe that if the dollar actually corrects up or resumes its uptrend, it would actually be good for US equity markets, as it is benefiting the consumer sector. It will probably put some pressure on oil too. It is also very beneficial for international markets, especially for Europe and for Japan. So we're more of the opinion that a strong dollar is probably supportive of equity markets, although it won't help equity markets explode to the upside. So we're thinking about equity markets that would continue to climb a wall of worry. And so we've seen quite a small correction here over the last week or so, maybe 10 days, and we can see that it has remained corrective. It didn't make it below the corrective targets. We would re-envisage a stronger correction down if we were to move below 2089 or 2090, but at the moment this isn't the case, and we believe that the trends should resume up. So correction down, possibly over, still an uptrend on the daily, still up in an uptrend on the weekly.
Thank you very much, Jean-Francois Owczarczak, for being here today.
Thank you, Daniel.
And thanks for watching. Do make sure to keep clicking back on the Dukascopy TV website for latest updates and exclusive interviews. Have a great day and see you next time.